Okay. And yet that's sort of what's the sale that's going on as far as for people to get involved in investment programs and so forth, is that we're going to beat the market. Isn't that right?
Well, there is a spoken or unspoken influence coming out of Wall Street. Wall Street's business is to sell. They make money whether you buy or sell. Their job is to influence you to do something.
Okay.
They present their information, which is a study of the past, and expect you to make a decision out of that to do something, buy or sell. They really don't care which. So the brokerage business is selling transactions, and they operate off of emotions. They attach to your emotional response to what's happening. Interest rates are up, interest rates are down, stock price is up, stock price is down, and because of that, you should make a choice. You should do something, either sell what you have or buy something new. And it is the emotions that drive that. So earlier we spoke about how important the emotions are. It is critical to how Wall Street works. If you want to be the most successful investor, you need to train yourself to overcome your emotions.
Now, related to this, again, a big part of the selling effort is saying we have all this research. We got lots of information here that's going to help you to make the better decision.
Yeah. So the spoken or unspoken promise from Wall Street is that we're going to study the past, come up with that research that you just talked about, in an effort to know what?
The future. Yeah.
So if I ask the audience, how many people know the future? I don't think anyone in the audience would know anyone that does. That includes the stockbrokers, by the way, or anyone in Wall Street. So truth is that nobody knows what's going to happen in the stock market. If we did, we'd all do it. If we knew what worked in the stock market, we'd all do it. We don't know what's going to happen in the future. So all that research does nothing more than produce a reason to trade with investors who are driven by their emotions. So when Wall Street says, we've got all this research, this is what's going to happen, this is what has happened, we think this is what's going to happen in the future, then and you react to it and make an investment decision from it, you're timing the market, you're placing trust in someone who says they can study the past and know the future, and so far that hasn't worked.
Okay. So these professional managers, okay, I think in general, I mean, there's maybe a secret trend that's going on really for more of them to be doing more of the index type of investing. But as far as the ones that are doing a lot of buying and selling, what sort of a record are they? Have they been consistently beating? Has anybody been consistently beating the market?
No, no one consistently beats the market. Recent study put out by Standard & Poor. Standard & Poor is a finance company. They have a series of index funds. Index funds are just buying all the stocks in a particular asset class, large cap, small cap, international large, international small. Those would be 4 different indexes as I described them.
Okay.
And those index funds put out by Standard & Poor are widely used in the industry. The most popular is the Standard & Poor 500.
Okay.
So you can't invest in the index. You have to buy a mutual fund that matches the performance of that index. It is true that most money managers are basically closet indexers.
Okay.
They're basically tracking the S&P or the whatever index that they're trading in. Standard & Poor's has done a new study. They've just put it out the 2nd year in a row now. And what that study found out is that the persistency of top quartile performers is at about 1% in the 5th year. In other words, out of 107, I'm going to make up the numbers here because I don't remember exactly, but out of 176 mutual funds that were in existence 5 years ago in a large cap asset class, okay, out of 176 funds that were in existence, 1% and that performed in the top quartile 5 years ago, 1% of those 176 funds performed in the top quartile in the current time frame 5 years later.
And it's pretty hard to guess which one it's going to be, I would think.
Yeah, I've been in the business for 30 years. I've been looking like crazy. I'd really like to know.
Okay. Why don't we talk a little bit about, I guess, timing the market. So this idea that, yeah, you know, I'm gonna buy when it's low and I'm going to sell when it's high, and I can time it, and I can figure it out. I've got this insight, because I have, you know, even some clients and so forth that tell me this. Yeah, I guessed that right, you know, that as far as how this worked out. And then, you know, but secretly, it's a little bit like the person that went to Las Vegas. They said, yeah, I won $100, but I lost 500. You know, yeah. So why don't we talk a little bit about that approach? Because a lot of people think, you know, this is it. You know, you're studying for, you know, what the big hit is going to be that's going to go to the moon, you know, the next big company, and the other is the timing thing. So let's talk about the timing thing for a few minutes.
So timing is guessing which stock is going to go the highest, the most, firstest. And if anybody knew, we'd all invest in it, but we don't know. And it gets back to something we said earlier, that nobody knows the future. Mm-hmm. So there is no way to study the past and have any higher expectation of success about knowing the future than not studying the past. Flipping a coin actually produces better results than active money managers do, who are trying to study the past to know the future and pick which stock to beat an index fund. Mm-hmm. So we actually get better performance from flipping a coin or throwing a dart at stocks on a wall. Mm-hmm. Than active money managers perform. So timing the market is exceptionally difficult. We talked earlier about the S&P 500 index fund. Over the past 82, 83 years, that index fund has performed 10% per year, 9.7% per year. And if you took out the one best trading day every year, if you were out of the market on that one best trading day each calendar year, the returns on that S&P would be less than 3%. In other words,
less than 3%, just by missing the one best trading day for the year.
Yeah.
So if you happen to sell and you say, I'm going to time this thing, but you missed that day, which by the way might be the day after a big fall.
Most likely.
Most likely, that you have to be back in right then,
yes,
in order to hit that recovery, yes, and otherwise you're going to miss out on like 70% of the market return.
Yes. Yes. So okay. Timing is really a loser's game. Timing will ultimately produce very low returns for you relative to a simple buy and hold of the marketplace.
Okay. Why don't we talk a little